And we are live on Oz Property Investors. We bring the big names and we have the big fun. How you going, Selena? How was your day?
I'm going really well, and I'm very excited to be here with you guys.
Oh, wow. It says 55 seconds. Why was it? I mean, I don't, yeah, that was live a bit longer than I thought. Maybe no, I didn't catch anything crazy. But how you go? How you going? That's good. Good to hear you're excited. And great to hear that you're well. And I love the. It's very authentic, your background. It's really cool. It's
Oh,
much more. I
home
love the
office.
books as
What can
well.
I say?
Yeah, yeah, yeah. So
I thought it
how
was a
you
screensaver.
No, not a
how,
screensaver.
how are you going, Joe? How's your day, man?
Mate,
Winning?
I'm fine. I'm super excited. I'm super excited for this one. I'm pumped to hear what's unpack some of the expertise that Selena has in this space. But how are you, Jeff? How was your day, mate?
Mate, I'm about as pumped as the as an AFL footy because AFL footy starts tonight, so they're about as pumped up as they can get. So, no, that's a terrible reference, but no, really good. So I'm quite busy, but I'd love to be focusing more on property, but unfortunately, sometimes you got to keep paying the bills. So, property is always in my mind. So that's these sessions. I really enjoy them. I'm excited to talk about something that not necessarily a lot of people think or we hear a lot about. So. Let's get into it. Let's get a quote going. So, do you have a quote for us, Selena? That you
I do. It's a long-winded one, so I've got to get it right. But I have a really dear friend, Brent Williams, who he's the teenage whisperer, and he coaches teams. And
Oh,
so he says this quote at the end of every program that he runs, and I'm going to try and get it right and do it justice, which is do the thing that you said you were going to do long after the feeling that you had when you said it has gone.
okay.
Do the
Yep.
thing you said you were going to do long after the feeling that you had when you said it is gone. It's
That's
quite deep.
That's not just for
it is.
teenagers. That's for
Yeah,
adults.
that's for everyone. Oh, totally. I love it. Like it really resonates for me. So someone
Yeah,
famous did say that, but it's a great quote.
yeah. It does sound quite familiar. The thing that is a lot of people go to seminars and they attend sessions like this and of course we love comments, questions, and thoughts. If you want to grow your own money tree, because that's what we promise. Throw how you let us know about that, and if you watch on YouTube. But people watch this and they get excited, they get pumped up, and then they 2 weeks after they forget they don't forget the content, but they get the feeling, forget the commitment they made to themselves. So yeah, great quote.
Hmm.
How about you, Joe? What's yours?
My quote today is from one of my favorite books called The Richest Man in Babylon, which if you haven't read it, go read it. It
Love
is
it.
our acts. What you know it, Selena?
Absolutely. Made my kids read it when they were 10.
Oh,
Oh,
that's
so
that's a
good.
hard. That's a
I
taskmaster.
bought it. No, it's a fantastic read. It's written really like basic.
It's a
It's all
fable.
just a fable. That's it.
Yeah.
And it's all just about the basic fundamentals of finance. So if you haven't read it, read it. I bought one. I bought the book for my brother for Christmas one year, and then I bought it for him again the next year. And I almost bought him at the third year in a row, but didn't realize he didn't have it. He's like, yeah. Anyway, so it is. Our acts can be no wiser than our thoughts. That is from The Richest Man in Babylon. Our acts can be no wiser than our thoughts. The actions that we take can be no wiser. And I found that quite poignant for this conversation because we're going to be talking about things that are a little bit different. Like we always talk about property. Property is the way, our investment vehicles that Jeff and I use to build our wealth. But there are alternative things that you can be doing in the property space. But if you don't know about them and you don't know what's out there, you're not really going to get some wise acts. So if we can all learn from some of your expertise, hopefully, Selena, as well, it'd
Yeah.
be good.
That's so deep. And yeah, I love it. I love that we're all being deep.
I don't know how mine. I don't know how deep mine is, but mine is in the end. It's not the years in your life account; it's the life in your years. So
Oh,
that's
that is
maybe that is
deep
deep.
too.
Look at
Yeah,
Yeah,
you.
that's
good old
I was
deep.
waiting for you to go get rich or die trying.
Well, yeah, that's yeah. I mean, I do quite admire 50 Cent, but I think he was the one who said that. That was his movie, but no, yeah, that to me means though that just because you live to sort of 80, 90 doesn't mean you've necessarily fulfilled your potential or promise. And you could Shane Warne, the passing a week and a bit ago, I feel
Yeah.
he lived large, and whatever people think about think about him and some of the stuff that he did. May not have been fantastic for a role model, but I think he didn't. If he wanted to do something, he worked out how to get it done. He was a great cricket player.
Yeah. Yeah. He said he was going to do something, and then he went ahead and did it, even when the feeling of wanting to do it wore off.
Yeah, I love it.
Love it. Okay, well, let's run into our sponsors, and then we'll dive straight into the introduction of this wonderful lady we have in front of us. Let's do it.
I'm excited.
Commercial property offers the highest cash flow in Australian property investing, offering exceptionally higher yields than residential. Now, we're talking 8 to 10% net yields. That's cash after all expenses, not this 2 to 6% gross that we see in the residential space. So for those that are starting out on their commercial investing journey, it can be exciting, but it's also a step not to be taken lightly. The expertise of a commercial buyer's agent can pay dividends to help you secure that high cash flow and high growth potential property. And this is why we recommend Steve Polisi of Polisi Property. With over 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He has seen it all and knows the best locations right for growth. In a previous life, Steve was a chartered mechanical and structural engineer, so he draws on his mathematical and analytical skills that he's developed to break down what works best in commercial property. As with engineering, same goes with commercial property. It's based primarily on the numbers. So if you're curious about diversifying into commercial property, you have access to $100,000 in cash or in equity, book a call with Steve today and find that perfect asset for you.
Well done, Joe. He's So and he's you know Steve quite well, I believe. So it's interesting that we tend to run in similar circles, and I think that might be a theme throughout this conversation. Is that a lot of I feel a lot of what you do and what you sort of is a lot of relationship based and understanding and putting together. But the reason why I was excited I was digging deep into who is the great person, Selena, in front of us. So you were previously a chartered accountant for 25 years. And certified PIA, property investment advisor as well. So you're not simply somebody who talks about this. You're somebody who's done the concepts in the back as well, background. So you've helped hundreds, maybe even thousands. I mean, I'm just going to say thousands, but I feel you've probably done 1,000 by now. But and you're passionate about financial freedom. So, and you've focused on this the last 12 plus years to help people to create their own cash flow machine. And listening to some of your content, that's what you are about, how to do that in a way that isn't sort of, I suppose, to borrow your words, eating the cow, but also just in a way that's sustainable as well, and to help people through that process. So that's why I was excited to get you on board. I'll get you on for a chat.
Thanks. That's a really lovely intro. Thank you. I'm still a chartered accountant. Still chartered accountant, slightly more reformed, but I appreciate the kind introduction.
So first question, or one of the first questions, just off the back of that, you're chartered. How do you feel being an accountant has helped you in your property journey?
That's an interesting thing. I actually wanted to be a vet, and I wasn't quite ready for leaving home at the time of going to university. So I did accounting as a backup until I decided what I wanted to do. But look, the skill set, to some degree, being a pure accountant was always a bit of a square peg in a round hole. But I knew that the skill set that came with understanding numbers and, being very at home with tax and legislation and interpretation of different things was super valuable. So, as a property investor, I think part of the challenge is, wading through the noise of, what's out there. And if you can layer that with an ability to at least read and understand numbers, I think that just gives you a little bit of an edge on what everyone's doing.
Yeah. Yep.
Yeah, 100%. Yeah, I totally agree. Like, I think that would be such a solid foundation for wealth building, is to be able to be an accountant and know all of the little eccentricities as well. Do I need a trust? Do I need what's the best way to structure this purchase? What's the best way to structure this debt? How do I actually do it? I don't know. What are some of the more like little known skills of maybe there's none, but are there any little things that being an accountant has made you to see the lens of the world a little bit different from a finance point?
Yeah, look, it's a really good question. There's probably a couple of things that come to mind. The first one was, starting my career with Deloitte, I got to work for some, what appeared to be ultra high net worth individuals, like, whether it was audit or tax or whatever. And the thing that just used to really confuse me was if these people are high net worth and, by all accounts, like from the outside, super successful and rich, why were they still incredibly stressed about money? So I think I had some really great insights into there being a disconnect between high income necessarily not being the same thing as wealth, and also high net worth not necessarily being the same thing as wealth. So that would be one thing that I think, through osmosis, I learned that. But I think the second skill that I found really valuable was, obviously accountants love a good spreadsheet, and I know it's a bit of a joke, but it was probably, by the time probably 2009, when we had, a reasonably solid portfolio, I started to run projections like, okay, well, I can't remember how many property we might have had, about, I don't know, 12 or so properties at that time. And I remember starting to say, well, if I fast forward where we are, like, when does the cash flow arrive? And so I think that ability to project with a reasonable degree of accuracy what's a likely outcome, and you can run multiple outcomes, an aggressive, middle of the road, and conservative. But
Yeah.
I think that ability to project your numbers and just keep seeing, well, if I take this course of action, this is the outcome, or if I take that course of action, this is the outcome, because that's ultimately what gives you that clarity about whether the property that you're thinking of buying is in alignment with your goals or not.
Yeah.
Interesting. Yeah. And have your goals, has that shifted? So 2009, you've got 12 properties. You've got, I imagine, more of like a growth focus. And then you're running these projections and you're like, oh, we're not going to hit cash flow for a very long time if we keep going down this growth focused path. What's our ultimate goal at the end? How do we actually transition to get there? Or like, was that a light bulb moment that you're kind of talking about now?
Absolutely. I mean, as an accountant, I was slightly ashamed that we'd been sort of on this treadmill of, okay, let's just, and we really practiced delayed gratification. We could have, gone and bought a bigger house. We could have done all sorts of things to enjoy the money. And we kept kind of saying, no, look, we'll reinvest. So, by the time, and 2009 really was the aha moment, because it's when I started to say, well, let's actually figure out, given everything we've done, where are we? And we'd also started to hit a bit of a ceiling with the banks, and, we were kind of I was, my tenacity around, well, what else, is how I kind of got it started in alternative. But I realized that at that time, after hustling and scrounging and putting these deals together, we were at least 25 years away from having the cash flow that we needed. And even then, by that point, I figured it was actually going to be fairly meaningless. So, as in it wouldn't have been enough. So that was I guess the real moment of like, hang on, there's something wrong if we're, setting ourselves up and we had high net worth on paper, but the proximity to freedom. My husband runs his own business, and I saw he was working super hard. And so I saw property as the vehicle to kind of, maybe break that cycle or give him some choice. So that was that was initially my thought was, oh, wouldn't it be great to just pay a few bills from property? And then when I started to kind of recognize that, okay, there's something, the model's flawed, because how can you have a high net worth on paper but be starved of cash flow and still expect to get some degree of financial freedom? That was really what took me down the path of asking questions around what else.
So is that where?
What was
Go, Jeff.
I was keen to know what was the reason why at 12 properties you weren't hitting or it was going to take you 25 years. What was the reason behind that at that time?
I mean, I think at that time interest rates were about 7 point something%. Like, I mean, interest rates were high. Yields were compressed. And the problem that I felt is that every transaction up until that point, and this is just the market we live in, the focus is on what is the gross return, the gross return, the gross return. And I started to say, let's stop focusing on gross return. What is my net return? Meaning not just the property expenses, but after my mortgage, like where am I going to be? And like at that point, obviously we had no idea that, 12, 13 years later, we were going to have such low interest rates. But at that time, it was, it was pretty scary. So I think there's a lot of investors out there right now congratulating themselves on, creating a little bit of cash flow with their current portfolio. But that will evaporate overnight if we end up in this high inflationary environment and interest rates go up. And I guess that was, it was hard. It was easy to get lending. It was hard to maintain and keep borrowing and moving forward.
Interesting. So one thing I wanted to mention, because it is St. Patrick's Day tomorrow, I wanted to try something different with this, because we've got a live audience, right? We've got a whole heap of people watching this thing. And I feel like sometimes people just, there's good interactions and people can jump in the comments whenever they want. But I would love to hear from people whenever they hear like a golden nugget, just jump in the comments. That's my takeaway, because we're going to talk for about an hour and a half. And if you can get just one key golden nugget out of this conversation, that means we've done our job. So jump in the comments if you get a little golden nugget moment, and we'll see if we've never done this before. So I don't know, it might just flop and no one will get any golden nuggets, but I think having a conversation with you, Selena, we're going to get a few. So if you already had your golden nugget, jump that in there now.
Maybe I should add a Guinness, Joe. Is that what you're saying? But no. So that's great, and I think should we I suppose dovetail into what alternative investing actually is, because I think that'll be quite helpful for the audience, and we'll get some gold there. So what in your definition do you find as alternative investing?
Yeah, so it's a pretty ambiguous term, and I do understand that it conjures up all sorts of fearful things. But I think the thing to understand is alternative investing, in a nutshell, just means anything that's not mainstream. So that can mean anything from, venture capital, seed capital, mineral mining, petrol mine. It could be anything. And then down the other end of the spectrum, you have what I think of as alternative investing, which is strategies which are backed by real property, meaning, there's bricks and mortar behind every deal. So when I talk about alternative investing, to some degree, it's still property investing. It's just from a different perspective. And to be perfectly honest, after having spent a lot of time in this space, I realized that it's not, we're not talking weird and risky. And in some cases, a lot of the strategies that I adopt, I would actually argue, are much lower in risk than going out and purchasing a typical piece of real estate where you're praying for the market to rise in order to win. In the alternative real estate space, predominantly you are investing for cash flow. So in most cases, in the sorts of markets that I operate in, whether the market goes up, down, or sideways, it just has very little impact on the cash flow, which is what makes it not a recession proof, because nothing's recession proof, but it definitely has an immunity to volatility and recessions, in contrast to other parts of the property market. And it has been totally, I won't say hogged, because that's not very elegant, but it's been very much the playground of the ultra wealthy. And I think I was talking to someone about this today. I think to some degree they've fostered this idea that it is risky because they don't want the rest of the mainstream audience to look at it, because it becomes their little pool of private playground. So but it's definitely not, we're not talking about super scary risky stuff at all.
So would it be good, are we going to cover off what those kind of strategies are? Like, what exactly
Sure.
is what? Oh, here we go,
Before
Jeff.
we talk about that though, Joe, should we talk about the free stage? You're putting the. I love Joe. Just wants to get to. Joe wants the answer. I think should we build up?
Show me the
and talk about
deals.
what-
Show me the deals.
I love that. But before we get into the free, how did you learn about this kind of things? You said it's potentially the playground of the ultra wealthy or the perception of it. How did you learn about it yourself? Like, what was your kind of process?
So as I said, I think it was late 09. And the banks just said, look, no more. Like you've sort of maxed out. And around that time when I started to map out my numbers, and I thought, okay, I've got to find something else because this doesn't work. And I really felt at that point, and I've continued to feel that way, that the wealth model that most of us adopt is slightly broken, or it is broken. And I realized back then that it didn't matter whether I did. I mean, and I have really been a student of learning different strategies. And I've done development and syndications and flipping and, everything that I could get my hands on to try and extract cash flow, better cash flow so that I could, really move forward in terms of, hitting that financial freedom. And it was really a throwaway comment by a friend of mine at the time who said, look, there are these really inexpensive, high cash flowing investments. And I said, well, let me check those out. And it was at the time, I think that this is where the accounting background probably came in handy. But I was very systematic about, I looked at lots of real estate markets all over the world, and I was trying to understand from a mechanics point of view, how did they work? Were they, international investor friendly? Like, how did the strategies work in those markets? And I ended up finding that the US in particular was very, it's a very entrepreneurial, the real estate market is way more entrepreneurial than it is in our market. And so it lends itself to very creatively structured deals. And I had plenty of cuts and bruises when I first started. I did all the wrong things. And I also, being Australian, I went, oh, well, owning property directly, that's what you would do if you're looking at real estate in other countries. And so as I kind of forayed into that market, and I came up with a very systematic approach for if you're going to invest in that market. And at that time, I was just doing direct property. How do you do it safely? And people started to just say, well, how did you do that? Could you share that? And I ran a few courses trying to teach people, how to do good due diligence in a foreign market. And then people started to say, well, that's really great. Can you help me? And so that was kind of the beginning of an accidental business really back then. And then that evolved into, property in our market. And really where I think of myself now is first and foremost is a strategist, because I like looking at what people have done and really just making the smallest tweaks to get them an amplified result. But yeah, it was really, I think I probably did it all the wrong ways, and maybe I'm a slow learner, but I felt that there was definitely something there. But it wasn't until I started the thing that made the single biggest difference to me was meeting better quality people as I went along. So, one person would introduce you to another. And then, I realized that in the space of alternative real estate, there are plenty of sharks, as you'd imagine, because there's opportunity. And the focus then switched from, I could see the deal flow was plentiful, but it was like, okay, well, how do I find the best people to share their experience and their networks with me? And so over the last 12 years, I've focused on ratcheting up into better and better networks. Some of the guys that I work with now, you wouldn't find them in a million years. They're not marketers. They don't need our money, but they're just awesome human beings. And I've really put in the hard yards to, make connections, both here in Australia and over there. To, these guys are self-made, or girls and guys. And what I know for sure now is there's no shortage of capital in the world looking for a home. The challenge is finding, quality investment opportunities to park your money in. And so those it's not that they only exist in private networks, but they are definitely coveted by private networks.
Yeah. Right. Okay. So when buying internationally, like if you were to buy in the US, what are some of the like key top points to be aware of in buying in the US, right? So
Oof.
buying in your own personnel name sounds like an obvious one that you might do and get in trouble with. I don't know. What else is there?
Look, the mechanics of investing in another market are almost like a side issue because you've got to get the mechanics right. I would argue that the criteria for selecting investments, whether they're here or in the US or in New Zealand or in Asia or in Europe, the process is very similar. You need to develop a set of investing rules. And what I advocate for my clients is I want to help them develop their investing rules because everyone's rules are going to be slightly different. But it's really about asking the question, you know, everything from, okay, well, what are your goals, and micro goals, and then alignment with those goals, because there's so much choice. So it's about, people think of, I'll give you an example. People think of diversification as, I'll buy a property in New South Wales and then I'll go and buy another one in another state and I'm diversified. Or I'll buy an apartment and a house and I'm diversified. And I think that's a really high level view of diversification. In my mind, if you're diversifying, and what I love about alternative, if you combine it with the best of what we have with traditional property, you can just 10x your results, and you can diversify from geography point of view, from a liquidity point of view, from a term point of view, from a deal maker point of view, and obviously from strategy. So if you do it well, you can just get this real blanket of safety that you just can't get by just being in one asset class by itself. So I don't know if that answered the question.
I think you answered it by saying that if it might not be the question to there's perhaps a different question to ask before going, whether
You
it's
need
in the
to have
US.
investing rules. The
Yeah.
thing that I see more often than not, especially with clients who've come and they've already got a little property portfolio, is their decision making around choosing the properties that they haven't always been well thought through. It could be an emotional decision, or somebody else said it was a really good idea, or they engaged someone to help them who told them that this was the next place to boom, or it was cheap, or they knew some infrastructure project was coming and they thought that was going to be the main driver. So there's lots of reasons we choose different properties, but very few people, and really what I'm advocating is people need to level up their thinking, is you need to have a set of investment criteria. Are you buying for growth, or are you buying for cash flow? Are you buying a speculative investment, or are you buying an investment grade investment? So there's like lots of levels to it, but and I don't really want to go down that wormhole, but it's if you have really good rules for guiding your investment decision making, it actually doesn't matter what market you're talking about or what the strategy is, because
Yeah.
the investment rules are kind of universal.
So what are some other investment rules? Like what's a good a good solid foundational base for people to be kind of setting themselves up with? Or is it more of it depends on who you are, what you do, how it works, like what's actually
I
going to be
think
good for you?
I think the crux of people's investment decision making could be quite similar, but I think it's, I have a 5-star system that I call it, and
Ooh,
it's
I like
everything from, yeah, so there's 5 pieces to the rule making, and you've got everything. Let's say, for example, in the alternative space, you're actually, there's a reliance on a deal maker. Like you're basically, you're trying to find people to partner with and leverage their expertise in a very deep and narrow strategy. So there's a whole process of, well, how do you vet that person? How do you know
Yeah.
they're legit? How do you know they've got the track record? And so there's all of that. So there's character and ethics. Then there's all the stuff about the macro, which is, economically, what's going on, like what's happening globally, country-wise, regional, and you would understand more than anyone that you can have within a suburb different sort of socioeconomic things going on. So there's a whole bunch of questions you might have.
I've seen it time and time again. It's I mean, even within a postcode, you can see demographics within an area, and and you can have price differentials of 100,000 sort of plus. I mean, more than that, I suppose. Yeah, so it's interesting. Yeah, go on. Sorry, you were talking about.
And then, then there's other things like the financials. Like, do the metrics make sense? So, for example, I mean, I have a lot of alternative opportunities in investing in Australia, but funnily enough, most of my clients, they lean more towards the US ones purely because there's more downside protection. There are multiple exit strategies. The cash flow is happening from today, from day one. There's a capital appreciation piece that doesn't rely on a rising market. I think, part of the big challenge that we have with our market is we need it to keep going up. So, there's rules and things. You can run the numbers. So what is the profit and loss? What are the you're talking about projections. What is the likely outcome? And I like to use a 5-year timeline. Like, where is this going to be in 5 years? What's the good, the bad, and the ugly?
Sorry, you go, Joe.
Yeah, well, how do you get capital appreciation without a rising market?
That was my question too.
That is
I think I know the answer.
Fantastic question. Good question. So in a lot of the projects that I focus on in that space, I am seeking forced appreciation as distinct from organic appreciation, which happens from a rising market. And the real difference between the two is that it's about purchasing an undervalued or underutilized asset, whether it's an apartment complex, self-storage facility, commercial property, and whatever it is, and recognizing that either it's not being managed well, it is dated. Like a good example of this, the best example of this, where some of my trusted advisors have literally minted money the last 2 years, is purchasing second tier hotel motels and converting them into affordable housing. And they have literally laughed all the way to the bank, because what they've done is they've purchased at cents in the dollar, because these things are like, all the hotels were going out of business.
COVID and all of that. Yeah.
Yeah. And we all know affordable housing is like a major problem globally. And what they've done is they've, methodically done a project plan over a couple of years to renovate and convert. I mean, people were able to move into those as affordable housing, and then they've just gradually. So what they've done is, let's say it's a $5 to $10 million asset, and they've turned it into, a $18 million asset by creating forced appreciation. Without
so all the hotel rooms are now just one bedroom apartments for everyday people.
Yep. So it's really, it's a socially minded project as well.
I've got a question around, because I listen to a podcast called Bigger Pockets, and they talk a lot about this on that as well. But and they talk about underwriting. What are some of the things? Because I look at an opportunity like that and I say, okay, great. I think there's brilliant opportunity here. But how do I know that it ticks the metrics that are going to make it a profitable project? Like, what are some of the key metrics you look at there, or your advisors look at?
Yeah, look, that is a great question, and probably deserves a really detailed answer. But this is where, what the truth of the matter is, the number one risk you face when you look at the alternative space is who you invest with. That is the number one risk. Because I know from firsthand experience that people can put together, what we call pro formas, meaning a projected profit and loss and a timeline, and it, glossy paper and photos, and it looks $1 million, and you go, well, that's fantastic. And then, the reality is nothing close to that. But one of my mentors uses a word which I'll describe as, it's called a risk-adjusted return. So when someone shows you a profit and loss, or here's what that asset will be worth in 2 years, you've got to apply a level of, you've got to adjust that return by, whatever you quantify the risk as. And that's a more complex conversation. But I'm looking for people with track record. I'm looking for someone I know, like, and trust, that I feel alignment with on an ethical level. I mean, these are people, and this is what I try to explain to people. You got to play the long game with relationships. It's not about, I think the mistake that a lot of investors make is they're just looking for the next deal. And often, like in the past, people would come to me and say, just show me the deals. And I would have said, and I say this now, hand on heart, that is the least important part of this whole thing. If you invest in growing your network, I mean, that's what completely changed my trajectory. Like literally just who you know. So the biggest risk in this whole equation is you've got to invest with people who, you know, and there are ways, obviously. How do you talk to past clients, you look at track record, you ask them questions about, you know, what kind of distributions happened in the last year, what was the last project you did, show me. And there are, interestingly, the better operators will align with an auditor. So there are organizations.
Yeah, they're happy to get it all checked over and gone through with a fine-tooth comb. My favorite saying, and maybe this should have been my quote of the week, was more lies have been told on a spreadsheet than a GM meeting or whatever there is.
Totally.
Like
Absolutely.
Any other platform.
And that's why you've got to be careful with, you know, when someone gives you a projected, like, here's what this is going to happen, you got to challenge it. And you really need to, you know, say, okay, good. And now let me ask you 100 other pointy questions.
Yeah. So are those type of hotel motel conversions in Australia or overseas?
Look, they happen here. The alternative investments that I see working best here are actually in the commercial space.
All right.
And, you know, on a large scale. So, you know, and to answer the question of what are the 5 buckets of strategies, and I think you sort of touched on this before, you've got, you know, small private funds that will invest either in a really niche asset or can be very diversified. The terms of, you know, your capital in those can range from, okay, you need to have a minimum 6-month commitment, or you need to commit for 3 years, or you need to commit for 10 years. So there's a liquidity issue that you need to be aware of, but minimum investments can be as little as $1,000 all the way up to some of the better caliber ones will have a 100K minimum, maybe 150. But, you know, as I said, depending on who the fund management team is or individual will determine, you know, where and what and how and all the rest. Then you've got, you know, syndications, which most Australians would understand, which is where you've got a group of investors that come together through a deal maker to acquire a single asset. And in that instance, you know, you're kind of in for the journey, which again, typically is 2 to 3 years is the sweet spot. I mean, you can go for longer ones, but 2 to 3 years is typical. And I like personally the ones that have a cash component, like a cash flow of say 8%. And then on top of that, you might get another 8 to 10% in capital return paid at the end of the project. With both of those two, I'm always really interested in what's the exit strategy, or what are the multiple exit strategies? What if the banking system craps itself? You know, what if this, what if that, you know, and usually these guys have got all of that thought through. So
what's usually somebody's answer to what if the banking, and what does the banking system crapping itself mean? Does that mean literally there's a run on the banks? Like, what are we? Yeah,
well, I think there's a lot of people whose strategy hangs on a refinance, or you know, and so if you are someone and that's the strategy to exit is you need to refinance, then there's risk in that. So again, you're coming back to that idea of risk adjusted returns. But yeah, I mean, really, there's no. I feel the more I know, the less I know, really, and I'm learning more and more. I think when I was younger, I was naive enough to believe that the mechanics of building wealth was a science. Like it was, you do X and you get Y result. And as I get older and wiser, I see that there's more art, because, you know, it's as much a head game as well as, you know, we talk about actions, what actions, but I think your outcomes are a function of thinking and actions. and one can sabotage the other. So it's definitely an art.
Yeah,
Yeah,
because
So
I
you've
imagine
got to
like,
track.
and this is where it comes in handy with someone like you. It would be that you've got a 6-month time horizon on this alternative asset, which you can then, once that completes itself, you can then fall those funds into this alternative asset, and then it goes into a project to do this, and then it's like optimizing the optimizing.
Yeah, look, I love liquidity events from the viewpoint that you've got that
Sounds
regular
fun,
out.
doesn't it? So
Yeah.
what's a liquidity event?
Well, when you get the money back, you get the money
Yes.
back.
When
You
the
put
deal
100K
complete.
here, or you put 20K there and 50K there and 100K there, and then they start coming back to you at different times. And it gives you that opportunity to reflect on, well, how did that go? How do I feel about that? Would I want to roll that over? Because like, in my group, I've got like 20 to 30, say, trusted advisors. Some people like splitting their money across a whole lot of different deals and different strategies. Other people just go, no, I just want to build a deep relationship with 4 or 5 of them, and that's me. And so I think getting your money back regularly and getting regular cash flow, or not, you could opt for a longer term, like just set and forget. But
Yeah.
I think it becomes quite fun. Investing becomes really fun when you're just like, and I say this, it's like going into a lolly shop and having only, I don't know, it's probably, you guys are probably a bit young for this, but like 50 cents to buy, choose your lollies, and you can only have a certain amount of lollies in your bag.
I'm not as young as I look. I remember going to, you go and you get them in those white paper bags, and you get, I don't know, 10 or 15 of them or whatever. Yeah, red frogs, and you get those mink things.
The freckles
that
and
was fun. Freckles,
yeah. So that's how I feel about alternative. It's like being in a lolly shop. It's just awesome.
I do like sweets.
So let's rattle them off. We've got small private funds. We've got syndications.
We've got joint ventures, and joint ventures is where you partner with someone, typically on an individual piece of real estate. So an example would be, there's a guy that we have in our group that, he buys really good quality houses, and then I come in as the joint venture partner, and I front, say, $20,000, and there's painting and it's minor reno. He then starts cash flowing that asset, and the goal is at the 2-year mark, he's going to sell it at 80% of its market value. And the reason he can do that is he's already bought it at a discount. This is why I'm saying it doesn't matter which way the market moves. There's so much of a cushion in there already. So he might buy it at 60 cents in the dollar, and then sell it at 80 cents in the dollar type thing. But the point is that at the end of the deal, so you get paid from day one somewhere between 10 to 12% per annum on that money, and then at the end you get a 10% profit share. So that takes your overall return for the 2 years up to about 15 to 19%. And that's a joint venture where you're kind of sharing. You're getting cash flow, but there's an element of sharing the profit at the end.
Spoils.
Yeah.
So is that the key? Sorry, is that the key difference between a joint venture and a syndication? Because I'm just, a lot of these terms sound quite similar to me in my understanding.
So joint ventures, if I say, for example, do the deal I just described, it's just me and the deal maker, just the two of us in that deal. Maybe a third investor if it's somebody else that's bought the deal. But yeah, it's a bit simpler, if you like.
And a syndicate can be
a syndication
sort of 10,
is
20,
many
30.
Well, it could be 100 investors, whatever. You don't know who they are, and you're pooling your money together with the deal maker, who, say, for example, might go out and buy a block of townhouses or an apartment complex or a commercial property, and it's just one asset that we're all in on together. So that would be the difference.
Let's get to 4 and 5, because otherwise Joe will out.
Yeah. So fourth one is what I call lending opportunities, or being the bank. So there are opportunities where, and you guys would understand this, the highest power at the table of any property transaction we do is the bloody banks. So there are people who facilitate opportunities, and you can do short-term and long-term lending, where you just get paid a fixed rate of return, typically 8 to 12%, and you get paid and you have security over an asset. So you're in the highest position of power with a rate of return. And like, I'll tell you, there's one of my trusted advisors specializes in like affluent blue chip property in one of the major cities, and has almost like two models. The first one is bridging finance, where he will charge 9% interest to people, and often very, very rich people who don't have a lot of common sense around money. 9% to, you know, a $20 million asset, he might loan them, say, 8 million. So it's a very low leverage, unencumbered asset. He's in first position. If after 12 months or whatever the term of the loan, that payer defaults, which they often do, apart from the ridiculous charges that might be in place, like there might be a $1 million penalty for defaulting.
Jeez.
The interest rate on that loan goes to 24%.
Wow.
And so, yeah. And so by the end of the whole, and you know, this guy has the legal and accountants. It's the most super lucrative deal I've ever seen in my life. It's amazing. And very, very low risk. So it's really fascinating. But yeah, that would be an example of a lending deal. And so you could participate in those deals. And then the fifth bucket, which is the one that we all know, is direct property. But there are probably a couple of permutations on the way that those deals are done over there. I mean, obviously the average price point for real estate is much lower. You can purchase a really nice home that you or I could live in for 100, 150K. And, you know, that'll rent for, you know, $1,000, $1,500 a week. So the metrics are completely different to our market. So it's very easy to, you know, buy real estate, either leveraged or unleveraged, and get a, you know, double-digit return, low double-digit return.
So before, can I ask a question on when you say over there, we're talking probably about the US or whereas, but oh, go, sorry.
I was just going to say, you can't buy property here for about 150K is my
that's
guess.
renting for, yeah. And given what I mean, because the US, I've been hearing some of the capital growth or appreciation seen over there, seeing sort of 30 to 40% in some markets. Do you still feel there's opportunities to buy these $100,000 to $150,000 assets? I mean, in areas that still tick the boxes. Well, I suppose it's
100%. I think the interesting thing about the markets that I prefer is that they are really boring. They are really dull. And so, like, for example, the East and West Coast tend to have very volatile markets that have these huge rises and then crashes.
Well.
Yeah, the markets that I focus on just don't have that. So you get a maybe 2 to 4% growth every year, but you're not buying for growth. Unless you're talking about forced appreciation, you are buying for cash flow.
Yeah. I like it how it's illustrated there. There's a rule just inherent in that. So there's some gold nugget there, is that you've unpacked it without even thinking about it. You're saying, okay, what is the purpose of the deal? Is it cash flow, or is it appreciation? And if it's appreciation, then how do I get forced appreciation there as well? So you're automatically it's a really great process. It's a cool process.
Yeah, well, some deals you'll do just for cash flow. Some deals you'll do just for growth. And then there's the hybrid in the middle, which is you get cash flow and growth. And you think it's really obvious which deals to do. But, you know, I kind of see my role is just to make sure that you're constantly like, is that deal in alignment with your goals? Is that deal in alignment with your goals? Is that deal in alignment with your goals? Like, I feel like a broken record, because sometimes it's really easy, especially in the alternative space, to get swept up in this idea of highest return. Like, oh, that one's paying 15% and that one's paying 12, so I'm going to go for the 15. And then you have to say, well, yeah, but that deal, your money's tied up for 3 years and you're not going to see any cash flow for 3 years. Whereas this deal, you're going to get monthly cash flow. So, you know, which one is in alignment with your goals? But it is, as I said, it's like being in the lolly shop with limited money.
You've only got so many coins in your pocket. Where are you going to put them, and for how long?
Totally, that's it.
What's the kind of what are the like the least riskiest? Like if you're a real low risk type of investor, obviously they will have an element of risk, but which is like, okay, this is a good place to kind of dip my toe into.
Look, for me, the risk profile of all of the stuff that I focus on is much of a muchness. Like I don't know that I would say that anyone in that group is a higher risk. It becomes what it ends up becoming is as you get to know these guys, you just fall in love with who they are and how they do deals and how they, the underwriting that goes into choosing the projects that they choose. But I would say if you're kind of just starting out, then doing something like one of those small joint ventures is a good starting point. And I'm a huge advocate of, just take small bites of the cherry, build your confidence so that, you can accelerate as time goes, but just be sensible. And that's the accountant in me.
Yeah. Be good to see that money straight away. You'd probably get people with the shortest period of time to see their cash realized so they can get that high and feel, oh, wow, actually this is happening. I didn't just put it in and it never came back.
Yeah, absolutely.
I think for somebody watching at home who may sort of be early in their property journey, it'd be good to, at what stage do you feel that people start to, are able to start getting involved in opportunities like this? I think I'm interested to hear your thoughts on that.
That's a really great question, and I think the way I would answer is to say, I try to have people think about the journey of wealth building in the context of financial freedom as being in 3 parts, and there's no question, unless someone bequeaths you a fantastic inheritance or you win the lotto, unless you're in that lucky position and you're starting like most people do and you're self-made, the first part of the wealth journey has to be about building capital. And the most effective way to do that is through leverage. And even though, for example, over the last 100 odd years, the share pundits will say, on average, the share market has returned 11 or 12% a year, and so's property. So they're equal. The reality is the reason that obviously property outstrips is because you can apply leverage. So I think that's where everybody has to start. The issue that I have is that people will say to me, Selena, I want to be worth $10 million, or I want to be worth 15 million or 5 million or 2 million, whatever the number is, because there's a perception that, if they have that, that remember, like over it was 10 properties in 10 years, or people laying out plans for people that says, well, if you buy this many properties, then you'll be free. And I know that. Well, I know that not to be true. And, I've looked behind the curtain of hundreds of investors now, high net worth individuals who just, people who have a property portfolio worth 20 million and they still aren't financially free. And so my comment is that first part of the journey is you need to build capital. But do you need as much capital as society tells you? I would argue no. I would say that if you get to a point in time where you've built a bit of a portfolio and you're prepared to divert a small percentage of that then into alternative, you can get into stage 2 of the wealth building game, which is about the recognition that maybe the cash flow coming off your portfolio is poor and you want to change the trajectory of it. So it doesn't mean liquidating everything you have. That's not what I'm talking about. I'm talking about how do you access a small percentage of your capital and put it into alternative so that you can 5x at least your cash flow and shorten your timeline to financial freedom, which, by the way, for me, it is a formulaic thing, but you've got to be really precise about what that means. And for most people, it's some permutation of they are creating an income stream which at least matches their living expenses and lifestyle expenses, and maybe they're debt-free on their mortgage. That's kind of like the the basic, level of it, and then it's everything else around that. But if you can change the trajectory of your capital, and instead of it taking, another 20 years or 25 years as it took me, I shaved that down to about 5 years. And so people will say, oh my God, that's not possible. But once you start to get your head into this, and I think I said this a little bit earlier, like there's a huge difference between something being unfamiliar and something being inherently risky. So part of this thing is like, this is all going to sound like Fruit Loopy, risky stuff. But once you actually understand it and you've got someone to guide you, it's not risky at all.
Yeah, if
or
someone's
not risky.
15 of these type of deals, 15 type of these deals, will the 16th probably be successful? Yeah, based on their current track record, it looks like it's going to be a good deal. And so a lot of investors are trying, like I find like we've got a lot of members of the group, and they're kind of just starting out. And one of the big focuses that they have is like, well, the ultimate goal here is cash flow. So why don't I just focus on building cash flow at the beginning? Like I'll just buy properties out in the sticks that are cash flow positive, and that'll give me the cash flow.
Look, if you are someone who has a very high income and you want to skip the capital building phase, I mean, obviously, even with alternative, you're building capital because there's often a growth component. But if you want to just bypass and go straight to alternative, then, there's no right or wrong with any of the strategy around your wealth building. But I'm saying, like, for 99% of people or 90% of people, build capital, change the cash flow trajectory. And then the third part of the game is, start to focus on structuring for annuities and legacy. It's a tweaking, like how do you stabilize and tweak? And I think if you can just embrace that idea that there are three parts, maybe even if you're saying, someone just wants to go straight into alternative, maybe it'd be heavier in capital-based alternative investments rather than the cash flow, because you at least want to give things a chance to compound for 5 years. So if you're in a situation where you don't desperately need to have that money to live and you can set that surplus aside, then there's nothing wrong with that. It's just that I'll put it a different way. Like what I love about the strategies and game plans that we build is I say plan A for a lot of people is their business and their work and all of that right now. Plan B is the alternatives, because that's kind of, you're ramping up the cash flow there so that eventually it's at least equal to what you're earning elsewhere. And then plan C is this property portfolio that you've got just bubbling away in the background, which is a fantastic safety net. And plan D might be something as dull as superannuation, which, nothing wrong. Super's great. But, a lot of people are like, why am I busting my buns to build a property portfolio if I can't touch things, if I can't touch it till I'm 65? So I guess I'm speaking to people who like the idea of financial freedom before 65.
There's a lot of people like that. There's a lot that want that. But I see it a lot where people, like when they're first starting out as property investors, they look at cash flow as the ultimate goal. So they put cash flow up here, which is great, but then they start with cash flow, but not build a solid asset base. So they don't put the growth property focus on there. And the problem with growth strategies and comparing them with cash flow strategies is that cash flow strategies have a lot of quick wins, right? $100 a week, $100 a week. Like we're getting these little win. A growth focused is negative 250, negative 250, negative 250, every single, like it just keeps going. And then all of a sudden there's a payday where you get a market cycle and all of a sudden it's jumped up $300,000. And then all of a sudden $150 a week is nothing for you when you've got added 330,000. I think that's where a lot of people can slip up, is not building that asset base, because once you have that, you'll be able to go and do these type of things. But people that come to you, Selena, that don't have that asset base and might have a couple of cash flow things, probably not really going to be able to do anything because they haven't got that asset base.
I think what you're saying is, Joe, that they want to do it fast. They want the dopamine hits. They're not willing to do the delayed gratification. It's kind of, do you take the sort of chocolate bar right now? Or do you take 4 chocolate bars in 15 minutes time? I remember I haven't nailed that analogy there, but there was that study on the kids.
It's called the marshmallow test.
Yeah, the marshmallow. Yeah. Where the kid who delayed it for 10 minutes. Yeah, I think there's probably some.
I think the philosophy that I have is, and I'm a big heart person, is that there's no right or wrong, right? So I would never want anyone to feel bad about the decisions they've made, but I would also say it's never too late to turn it around and start making better decisions. So, if you are someone who, and I meet people all the time who've maybe made, and the problem with Australian real estate is obviously that it's so expensive. So it's almost like you can't afford to make a blunder because it's expensive to make mistakes. But people beat themselves up about it. And I just think part of the journey around wealth building is being able to digest mistakes and losses, because everybody has them, and just be able to, learn from them and move on. So building capital isn't always critical. Go for it.
I was gonna. What's your? I wouldn't call it a mistake, because I mean you call it a mistake or whatever you call it. But what's your number one learning opportunity? Because from your real estate journey.
Well, I once.
You can have 3 if you want them. If you want, or is it hard to pick from one?
Yeah.
Or is it, you never made a mistake,
No, I've made tons of mistakes, lots of cuts and bruises, and a couple of gashes. We made an investment decision in 2008, which resulted in us losing the house. As in, we had paid it off, and then we pulled it all out, and that really hurt. And unfortunately, the way that we lost it was basically through a joint venture that we were going to do for a development site, and basically the joint venture partner took the money and ran, and that really hurt. Like, coming back from that was, obviously there was the financial, but it was the emotional. For years I just thought, like, what did I miss? What could I have done better? And luckily for me, I have a super understanding husband who, he was just like, he is a bit more roll with the punches, and he said, well, we made that decision together and we did all the right things, we got all the right legals, and it just worked out. And you can never account for that stuff, but the learning for me was around taking that level of risk at that point was probably a dumb mistake. So I've definitely, as I've become older, become more conservative in terms of how much of a percentage of my net worth am I going to risk in a single deal. And maybe to some degree the success we've had has been because we've redlined on the finances as far as delayed gratification, but we've been pretty careful other than that one around what percentage of capital are we prepared to put in a single deal. Because I've just met too many people who've lost it all on just, I'm going to put it all on red. And that's luckily we didn't do that. Like we didn't actually, have to sell anything or physically, move or anything like that. But it really hurt. And I mean, if I'd had that money in today's market, that would be multiple millions in terms of opportunity cost.
Yeah, well, thanks for sharing. I mean, that's it's.
I can laugh about it now. Not really. No, it's it definitely shapes you. That's for sure.
Yeah. I mean, would you say that, because I'm just thinking about the people that are focusing on they've got their journey there at the moment, they're building their capital. Would you say that people sort of extending a little bit too much? I mean, I suppose I'm not sure. I'm just trying to liken it to hopefully show to people that maybe to not necessarily redline too much. But how do you sort of, I'm just thinking, if somebody's building a residential portfolio and given a low interest rate, how do you somewhat protect or de-risk when you're borrowing somebody else's money when it's not? Whereas I think in your situation, it felt like you were putting cash in the deal. So obviously And obviously, but you're going to lose real money. So how do people, because it becomes, you numb yourself a little bit to it, I think. And you think, just take another loan.
No, look, that is a fabulous question. And what I would say is there's probably levels. Like, number one, and I think, in my nature and my training, like, I'm pretty conservative. I would say keep really good cash reserves always. Like, never find yourself in a situation where you just don't have the money behind you to solve a problem. The second thing I would say is that, I think be aware of the environment. Like, the biggest elephant in the room, as far as I can tell right now in the world, is we are about to enter a super high inflationary environment, potentially with a lot of volatility. Like, we've seen a lot of volatility in the last couple of months. And as an investor, you have to be aware of that. So when I say that, like, obviously owning real estate is one of the best hedges against inflation, because in theory, with inflation comes, increases in rents and things like that. But they don't always go up together in a straight line. So if interest rates kind of do jump in the next 2 to 3 years, how are you going to be with it? And one of the things that, really, and I do bite my tongue, is seeing younger people redline it in terms of going after properties as their primary home, as the first home they're buying, and just mortgaging themselves up to the hilt and saying, well, we can afford it because interest rates are at 2.5%. But, like, I just, here's my feeling, that the last 2 years was a massive fracture to the world economy. And how can there not be consequences? How can there not be ripples? And, to be honest with you, it's all been rainbows and unicorns for the last 2 years for most people financially. And there's a lot of people out there congratulating themselves on the gains that they've made over the last 2 years. Yeah. But the people that I keep company with are far better economists than I am. And I'm hearing the dialogue, in my trusted advisor group about, this is coming and this is happening and tremors in the market. And, you just want to be careful.
What's it going to look like? What's it going to look like, do you think?
I think we're all sensible enough to say there's no crystal ball. You just don't know. But I do feel, I hope that economically we can have a soft landing, in our country. And, I hope the whole world is soft, soft landing. But I just feel that, I think there's been a lot of people who have invested from FOMO, the fear of missing out over the last period of time, and just exercise caution. I'm not saying don't buy, but make sure you can afford it. Make sure you don't put yourself in a position where something gets taken off you.
I'm seeing it time.
Interesting you mentioned there about. I was just going to say there's just a quick book that I was listening to a podcast the other day, and it's a guy who wrote this book called The Lords of Easy Money: How the Federal Reserve Broke the American Economy. I don't know if you've read that one, Selena, but
no, it sounds great.
It's just I was listening to it, and it was if anybody in the group wants to read that and let me know how it goes, so I don't have to read it. Give me the
look, I'll put it on my list. Lords of Easy Money. I've written it down.
Go on, Joe.
Let's pop into our sponsor, and then we will jump into some more questions.
There are some questions that interesting ones that come through.
Throw some interesting questions through, people.
This live session is sponsored by Scott Agate from Hello House. Scott has created the world's first property negotiation as a service business. So what does that mean? Well, let's think about it. When was the last time you negotiated on anything over $100, let alone a property that is going to be one of the biggest investments of your life? The vendor, they have a trained negotiator on their side in the form of a real estate agent. That's kind of like you stepping into the ring with Mike Tyson after never training a day of boxing in your life. These guys are trained professionals, and that's what they do day in and day out. And this is what Hello House does every single day as well. They negotiate on property to get the best buy price from the real estate agents. Scott Agate, he's the expert negotiator. He has been in this industry since 1995. He owned and operated 3 Bell franchises. Scott was the guy that was teaching these real estate agents all these agent games. He knows all of their tricks. Having him on your side is going to give you a massive unfair advantage and literally save you tens of thousands of dollars. Unlike other ways of purchasing property, Scott's incentives are aligned with you, the buyer, meaning the more money he saves you, the more money he makes, which is what you want. You need to have those incentives aligned. Scott has kindly offered our group a massive discount on the retainer fee for his service. So if you're looking to buy your next home or investment property, click the link below to get in touch.
There you go, Joe. Oh, you played it again.
Wow.
Press the button
These are
twice.
sexy ads. Sexy ads.
Yeah.
Something different, something fun.
Yeah.
I've got a question, Selena. I'm interested in, and it's a very big, broad question, but why has the property market gone up so much in the past 2 years? Why?
Oh my God. That is a
How long
very
you got, Joe?
economic, technical question. And I am not an economist. Look, I think it's a little bit like,
You've got some in the
let
group.
me ask you, why do you think the secondhand car market has gone insane?
Supply, isn't it? I mean, I don't know. The supply and demand. I mean, that's my very I was going to say uneducated, but that's my very
there's
initial.
definitely, there's an element of that. But I think the argument across the board for why a lot of goods and services have gone insane over the last 2 years is that people can't travel, they've got money in their pocket, and they're looking for places to park it. I mean, and I've picked up a lot of insights in terms of even watching blockchain and what's happened in that. Like, people just have money and they want to put it somewhere. And as I said before, there's a lot of capital looking for a home. So people are prepared to pay over the odds. Then, if you look at property, there's lots of reasons. Like, I've heard the expression, the bloody Victorians, many times over the last year, because everybody wanted to live somewhere better. Like, everybody wanted to, there's a lot of, I think, and it's hard to quantify, but there's been a lot of shuffling of deck chairs. Like, it's like, I don't want to live here. I want to live where I want to live. And that, put pressure on a very small supply at one point, and that started to drive up prices. And so, it's a bunch of things. It's not just one thing. People have more money. The government is trying as much as possible to keep everybody optimistic about the economy. People are shuffling deck chairs. People want to live where they want to live. And then there's a lot of FOMO. Like, that's all compounded with, shit, the market's gone insane. It's gone up 30%, 40%. I better jump in. So it's lots of stuff. That wasn't a very, elegant answer, but I think it's, those few things.
I think it was very. There's a lot to unpack in that sort of question. That and I thought you did fantastically compared to me, sort of saying supply and demand, which is the old cop out kind of. I don't know, why is it going up? It's like,
but it's true. Yeah. It's true.
Yeah. I think it's going to be interesting to see, because they're saying that the Fed's going to. I mean, I think they said there's a 96% chance that they're raising rates in the US by at least 0.25%. So I think 2.25% will be what it is. It'd just be interesting to see what that does to consumer confidence, not just in the US, but I suppose globally, because we look a lot to the US and Philip Lowe still sort of. I mean, not that I'm a crystal baller too much, but he's sort of saying that there's not going to be unlikely to be a rate rise in 2022. But who knows if he sort of loses his nerve. Yeah, if he loses his nerve a little bit and says, well, inflation's gotten now to 7%, we can't keep this going. We need to act a bit quicker than what I said. But I think there's a couple of. Does that answer your question, Joe? Or do we need to?
Jeff, I'll just add to that. One of the things I think is really interesting right now is the debate on how is inflation actually measured. Because, and I know we're completely digressing from property here, but it's a really important conversation. And if you look at a lot of really well-educated economists, their view is that the governments will always manipulate the way that CPI and inflation are measured in order to keep the economy sentiment, as you mentioned, on an even keel. And there are some arguments, because there are some indices which are a basket of goods, where they've shown that the government have changed the basket of goods in order to keep the number at roughly 2 point whatever percent. So yeah, I don't know, but you know, just quietly, I went and got petrol on Friday to go away for the long weekend here, and I was just flabbergasted at the price. I don't fill up the tank very often, but when I did, I was like, "Holy cow, $2.10 or something like that." It was just insane. And
Yeah,
you know, I spoke to
absolutely
one of my clients in New Zealand the other day, was telling me it's
Is it
where he is,
$3?
it's almost $4.
Oh, geez, yeah.
Wow.
Wow.
Yeah,
That's
so
ridiculous.
you
Yeah,
can't
and
tell me there's
how is that not inflation?
how is that not inflation? I don't know if you know, puppies and things like that are in the basket of goods, but even, you know, secondhand cars, dogs, puppies, they're just gone insane. Someone paid $15,000 for a beautifully coloured cavoodle the other day. I'm like, oh my
Oh,
God.
wow.
Wow. That's better
I
than
think we
an
need to start.
NFT.
Let's.
Oh
Oh,
no.
yeah. Well, let's
Anyway.
we'll get back. We'll get into some let's get into some questions. And I think that Joe's probably one thing that's I don't know how. So this question is from Aaron, and Aaron's pretty much here every week. He's our biggest. We should give it. We should send him something. Send him a medal or something. I don't know. Like, I love how engaged he is in our lives, and just he's always here most of the time. And he's saying, any tips on finding high quality resi properties in Australia, good cash flow? So I think the second part of that question, any types of properties or areas to focus on. I think the area, I don't know about I think the first part is a great. So I'd be interested to hear your insights on that. Do you have a metric or a framework on how that looks?
Well, I'm a big researcher, so you know, I like research and I like data. And the big thing that I kind of advocate is don't rely on, I mean, be careful where you get your information from. That's number one, because I think there's a lot of property marketers who are great at selling property through data that they collect. But I like looking at council websites. I like looking at different data houses. And you know, you guys would recognize this. If you go and look at vacancy rates for a particular suburb, you know, one source will have one rate and another source will have another rate, and it's because of how they measure it and all that kind of stuff. So I think, you know, do your research, find data, pay for data if you need it. Use buyers agents who have that data, who will give it to you as part of their service. You know, I think I have a bunch of areas that I really like, but it's not through anything other than I just researched heavily. I think one of the, you know, it's difficult because you don't want to actually name areas because you don't want to get, you know, you don't want to create problems or, you know, put people off track. But I've had better experience in some of the major regionals than I have in the big cities. Not so much for any other reason than I can buy a good quality property that is very close to neutral cash flow, you know, either slightly positive or slightly negative, and then I just set and forget. And I think for me, like, I've never been a high income earner, but one of the things that, you know, helped us keep moving forward was not having all of our eggs in heavily negatively cash flowing properties. You know, obviously you get some really good cash flow in a negatively cash flowing properties. And if you can tolerate that cash, if you can afford to carry that, then yeah, by all means, throw some of those into the mix. But I think for most people, and I think you know, the investor of 2022 has to think very differently to the investor of the year 2000 when I started. Like, it's a different game now. You know, the things that worked in 2000 don't necessarily work now. And if we do all have finite dollars and a finite borrowing capacity, the question is, how do you make the most of that? How do you stack the odds in your favor? So I know I'm being very generic, but it's like types of properties or areas. Yeah, you
So
just
true, because we're constantly balancing between the cash that we have and the borrowing capacity that we have. And every purchase needs to align with that, so you can just stack them one by one. Whereas if you go a unit number, like a number 3, and you haven't done a 1 and 2, that might hamstring the entire process and throw you off course. That's very well said.
Absolutely.
That's my goal. That's my golden nugget that you said today, actually, is I could buy a X property, you know, an $800,000 property in a region, in a major city, or I could buy a high quality, good property in a more regional location that is a better asset, like actually the best price, the best property for this. Whereas if you're buying an $800,000 property in a city, it might be a 1-bedroom apartment in a unit complex of 90 other properties. That's not a good use of asset. Get the best asset in the best location at the best price. That's my golden nugget. That's solid.
Thank you. I think honestly, investing is about how do you stack the odds in your favor. So exactly what you said. If you buy in a high density area where there's already a zillion units at that, and then someone has to sell in a fire sale, and then the market is set, you could be screwed. You want to have the highest.
What's your comparables?
Control.
You just look at the comparables. Oh, that one sold for 600. Okay, well this one will sell for 600 or less or more. But that one went 600. This one went 580. Guess where you're going?
I think
I did read
Sorry,
I was just going to say I did read a report very recently that even with the insane capital growth that we've had for the last couple of years, that the average capital growth for houses with land was double that of units. I don't know how true that was, a news article, but I just remember thinking, wow, that is a significant difference, not just a little. And when I've coached younger people,
units.
Totally. And when I've coached younger people, sometimes they let money burn a hole in their pocket, and they just need to get their foot in the door on the property ladder. And I remember a couple of years ago, I was coaching someone who she was in her early 20s, and she had enough to go out and buy a $350,000 to $400,000 unit. And I could see that she'd saved that deposit she was in the workforce, she'd saved it over a couple of years. And I said, well, yes, you could go and do that. But if you wait another 6 to 12 months, you'll actually have enough money to buy a house in that same market. And within the first 6 months of her buying, and she did that, she took, I gave her the options, and she bought a better quality property. She had to wait 12 months. And within the first 6 months of her buying that, she made 100K. And that is because she made that decision to lean more towards quality. And if you think about property on a bell curve, what I've tended to do through most of my purchasing is avoid either end of the bell curve. You don't want to be a slumlord, and you don't want to own just blue chip. But if you can buy as many properties as close to the median, either slightly above or below or at the middle, you're going to have more tenants to choose from, and you're going to have a bigger pool of potential buyers. So I don't know. When I talk about stacking the odds in your favor, I think that's something you got to think about.
And I think even taking a step further is, do you want to buy the asset in the suburb that's the 5-bed, 2-bathroom, how many people are going to buy that versus the 3-bed, 1-bathroom, 3-bed, 2-bathroom, that you got more kind of competition for that type of asset. And sure, the 5-bed, 2-bath could go fantastically well, but it's how much are you going to put into that? And I think that's a gold nugget that I think Joe started something here. There's people throwing it left, right, and center. So Joe, you're on a winner, mate. Good on you. It's St. Paddy's Day tomorrow. So the thing that I took, there's heaps of things, but the one thing that I've kind of is it's really about going back to your rules. You're kind of, because if you don't have those, then if anything looks and talks like a duck, then it'll be a duck, right? Whereas if you actually say, well, no, I want a duck that is white, and it's late. I mean, you'll be more specific in picking out those kind of things. Analogy isn't fantastic again. Sorry for that.
Terrible analogy.
No, well, I don't know. On the fly, in my mind, it sounded good. But that's the thing I'd say to people asking a question like Aaron. He said, "Good cash flow." What does good cash flow actually mean? Like, is that 8% or is that 4%? Good is a very get us. I mean, that's my kind of view. I think
relative to your situation, right?
Yeah. 100%. There was another. Is this a question? Thanks, guys. Especially when nearing your borrowing capacity, do you always consider lenders? I think I don't know if you know. You may or may not know a lot about this. This is quite specific, so you may need to.
How do you keep going? As in, is the question asking how do you keep getting money out of the banks? In essence,
yeah. Yeah,
Probably. Looks like it.
That's what I'm taking
Look,
from it. But I do want to know the answer to that question, even if that isn't his question.
I can tell you now, and I have clients, and even myself included, with substantial equity. And the challenge with the banks right now, it doesn't actually matter what your net worth is anymore. It literally has very little bearing. And anyone that has dealt with the banks over any period of time, you will have noticed that back in the days of someone like Steve McKnight, who could borrow to buy 100 and plus properties, the reference was always to the deal. And that is still the case in other countries, including the US. The reference is to the property. So there's no cap, or the cap on how much you can borrow is significantly lower. Whereas in our country, the banks and the lending authorities are deliberately trying to put ceilings on how much people can borrow. And there's a level of conservatism there that probably comes from the hangover of the global financial crisis. There's concerns around affordability. So people government don't want runaway capital growth. And it's a double-edged sword for the government. If you think about it, like on one hand, they want a booming economy, and generally a booming economy is associated with rising property. But then if it rises too much, then people can't afford it. So it's a tricky, and you will have seen over time, the governments will pull different levers to do with interest rates and monetary policies and things like that to try and do things in the property market, and mostly they fail. They just don't quite get the outcome that they were hoping for. So
it's a tough one, though.
How do you get more money out of the bank? Simplest answer.
And more money.
Go start a business and earn more money. That's the answer.
Well, yeah,
get a side hustle.
Yeah, I'd say, how do you keep going? So asking the question, how do I borrow? What do I need to do to borrow more money, and go and do that?
Structuring your portfolio as well, like what are you actually going to buy, and how can you ensure that is going to allow you to buy the next one, and then the next one, and then the next one, and the next one.
But I don't think you can do that anymore, Joe. I don't think the banks are like that anymore. Even if you're well structured and you've got multiple entities and companies and things like that, a good bank will look across that. But what I would say is, sometimes through loyalty we stay with banks because that's who we've always done our banking with. And what I would say to investors who are earlier on the path is, you've got to be a dog with a bone. I think part of my own success with property has been that not giving up. Okay, so you're telling me no more money over here, I'm going to go over here and ask questions and ask questions. Look at second tier lenders. Look at other finance options. Like, please don't go and borrow money from a loan shark or anything like that. But just, people will tell you that you're not going to get a better deal with another bank. But I've found that to not be the case. So if you have time and the energy to shop around.
Yeah, obviously you should expect to pay a higher interest rate, but if you've got a good enough deal in front of you that stacks up and you're willing to take that on, then it doesn't really matter. You just take the deal and pay the fee.
Yep.
But if it doesn't stack up, don't do it.
This has been a high-powered, energetic session, so I want to be respectful of your time, but I think there's a couple of really cool questions that I think this is from Tone. Tone also, he loves a pork roll, apparently. I think he keeps going on about him, but he's saying here, where you've got, and we're not giving specific advice here, people, by the way. You got to make your own decisions. I think the second question, I don't know, I'll leave it up to you whether you want to answer that, but what are your thoughts? I don't know.
Let's read it out. There's two projects with similar risk profiles, one with regular monthly payments and one with a lump sum payment in 3 years, the liquidity event. How much is the liquidity premium you would assign? Also, do you facilitate or reassign deals between investors so they can exit early than planned or committed? That's a very specific question, isn't it?
I don't know. When you say liquidity premium, I'm not sure what you mean, but I don't facilitate any deals at all. I don't advocate deals. I don't get paid on the back of any deals that anyone does. So I don't reassign or assign. My goal is to be the guide and help people build out a plan, introduce them to my network, and help them make good decisions. It's not to point them in the direction of any specific deal, and it's certainly not to facilitate. Yeah. And the whole thing about exit. Sorry, what was that?
You're a money coach rather than, or is that what term would you?
Yeah. You're a wealth coach, mentor.
Wealth consultant. Yeah.
I feel very holistic about wealth. So often people come to me because they want access to, better quality deals. But I will only work with people who want a holistic view of, well, okay, yes, you want help with deals over here, but have you really optimized what you already have? Is your borrowing right? Are you holding the right assets? Are there any lemons? Is there alignment with what you have and what you're trying to achieve? Is there any deadwood? Like all of those things. And then what other assets have you got? So, it's about creating a dashboard so that you can track your wealth health holistically, not just in isolation.
Great answer. I think that
all on one page. That'd be fantastic.
Yeah.
Love this one. Love this one.
Speak the language of a fighter. Interesting. You need that attitude to be successful, not only financially, but in day-to-day life will include as well, including personal relationships. Wow.
Yeah. Look,
I think of a fighter. I actually agree. I think you do.
Oh, that's lovely. That's a really kind comment. I think people like us, most of the people on this call would be self-made. That they're not anyone who was given a hand up or a handout. So I'm a huge advocate for those people. I feel like I'm living proof that you don't need to earn crazy income. I mean, I didn't ever have a great income. I just focused on what can I do with the limited surplus that we have to, get the biggest result. You've got to be passionate about it. Like, I feel that we are a nation, unfortunately, that doesn't like to talk about, the idea of wealth because, we're a very, equal socialist type nation and that no one should be left behind. And I get it. And it's not that I think anyone needs to brag about it, but I think you need to be fierce about your desire to build wealth. Quietly fierce if you like. But yeah, I do feel like if you're not prepared to fight for what's important to you, then how can you expect, that it will arrive?
Yeah. My favorite quote is, nobody cares as much about your money as you do. That if you can't just hand over your dollars to someone without you understanding what that thing is, because that's where people get taken for a ride. And it's awesome that you can, that's why, in this group, we've got like this, 15 questions to ask a buyer's agent, which are all very uncomfortable questions for the buyer's agent, but it just uncovers the shark. If there is a shark that is a spruiker, boom, within 15 questions, you'll know. Just get educated. And that's a perfect prime example of the people that are on this call. They're looking to get educated. And we didn't really tell too much. Alternative assets, what the heck is that? But there's so many other opportunities out there. So yeah, I love this call. Are there any more? Here's a comment actually, and this ties in nicely. So how do people get in touch with this room?
So I think the easiest thing is I have a podcast. So I highly recommend, if you're interested in wealth and mindset and strategies and, how to get traction with your wealth journey, then go and check out my podcast. It's called the Alternative Investing Podcast, just for synchronicity. And if anyone is interested in finding out more about what I do, you can go to inkosiwealth.com, INKOSI wealth.com. And in case you're interested in why I came up with that name, Inkosi is the Zulu word for tribal leader. And it was something that came up in a book that I read when I was younger called The Power of One. I don't know if you ever read that. It was a great book. And basically PK, yeah. And so Incosi has become the number one metric that everyone inside my membership, my mastermind, tracks. And it's the great equalizer, because someone like, Jeff might have a passive income goal of 100 and Joe might have a passive income goal of 500,000. But Incosi is always described and shared openly between investors as what percentage of your goal have you achieved. So, many, many investors are on zero. As they come into the program, they build up to their 100%. And so Incosi is about all of us wanting to be leaders in our own tribe. So that's where it comes from.
So all the members in the group, you kind of set that tone and set that frame of being like, cool, what is your end goal? Okay, now where are you at? Great, I'm at 12. I'm at 25.
12%,
It's the great equalizer, because, nobody likes to talk about, what they're worth and how much income they have. And so there are sort of 4 other
as a percentage though. Yeah.
Sorry.
Where are you on your journey?
4 other metrics, did you say?
Yeah. So we have a dashboard. Like, you remember I was talking about, like, you got to look at wealth holistically. You can't just focus on net worth. Like, that is obviously one metric, but it's one of, several. But Incosi is kind of like the guiding light, the North Star.
So what are the other 3?
Oh, now you're testing me. The dashboard is, one of the things I ask people to track is working capital, because often we tell ourselves, oh, we've got this net worth of blah. But by the time you take out personal assets and your house, most people have nothing or very little. So, you want to track your working capital. You want to track your wealth health quotient, which
How do you track that?
Well, there was a fabulous book, and here's the book that I would encourage everyone to read, which was The Millionaire Next Door. It was written about 25 years ago. And what it says, and this is the mathematical part of the night. If you take your household income, gross, before tax, you multiply that by the average age in the house. So whatever, like if you're 40 and your wife's 40, then it's 40. And then divide by 10.
What's that?
So that was what the formula of the book was. Now, so when you work that number out, that is the number that allegedly, for the income that you are currently on, and there's we understand that will have gone up over time, that is the number that your net worth should be at a minimum. If you're above that, if you're 2 times that, if you're 2 times that, then you're killing it. If you're less than half that, your net worth. If you're less than half that, then you're struggling. But I would add another dimension to this, because especially in our country where, as we know, the metrics are a bit out of whack, instead of dividing by 10, divide by 5. So your gross household income multiplied by your average age in the house divided by 5.
Divided by 5.
There we go. I've just found a page.
Absolutely.
I'm going to post.
Oh, it's the household income. I didn't add the misses.
Gross income.
Didn't add
So if your gross household income,
I've just put a link to the people can check out the if you're watching.
I've got a worksheet formula for it. Like, and basically, if you look at that number and let's say it comes out at 1.5 million, and your net worth is more like 700,000, what that tells you is, don't feel bad. It just tells you have not been very effective at converting your income into wealth, into net worth.
I'm pretty sure I'm behind the times. I'm behind that formula.
If you are well above that, like 2 times that number, like let's say the number spits out again 1.5 and your net worth is actually 3 mil, 3.5 mil or whatever, you're doing well. You're doing really well. So anything above 2 times that number is you're doing really well. So that's called your health wealth quotient. And I get people to track that. So that's obviously a number that doesn't move quickly, but where you start and where you finish, you want it to be much better. And it's never too late. So that would be another one. What's another one? God, I'm having a mental back. I could bring it up and then I could show.
Probably be cash flow would be one, right? Like what's the net cash flow of your portfolio?
Yeah, net cash flow. Well, that's kind of a reference to Incosi, like your passive income, your percentage of passive income goal. And what was the other one? I'm going to bring that up. What did I call it? Dashboard. Here it is.
Joe's asking all these challenging questions.
Oh, I know. You know what, Joe? You can put it in your show notes.
Beginning.
You can put it in your show notes. I'll find them out for you.
We'll have to turn this into a podcast first.
You put it in.
We've almost turned this into a podcast. By the time this is on YouTube, and if you've made it this far, we'll make it into a podcast.
We'll do a post about a podcast. Yeah, there we go. So yeah. Well, I just wanted to say, Selena, I really appreciate you jumping on and for an hour. And we always say there's between an hour and a half. It's now been an hour 40. But I appreciate your time and just your passion and your tenacity. I would say, the person described it as fire, but I think you're tenacious and cozy. South Africa is a fascinating place, and I love the place. I've been there and spent some time there. Just a really kind of interesting sort of history, and not always sort of great history, but so I think you embody a lot of that in Cozy, your tribal leader. So good on you for creating your community, and thank you for coming on and sharing some time about us and our community.
Oh, it's a total pleasure. It's great to be here with you guys. You're so passionate yourselves. It's very contagious.
Best value session, raw and real. I love it. I want to thank you as well, but I think everyone else has done it so well. Selena, thank you very much for taking the time. This has been amazing. Look at it's all coming, all the love.
All the love.
Is there anything else we should cover off or mention?
Look, I think it's an interesting time in the world right now, and just be careful what you ingest in terms of, like, we're talking property. There's too many people out there who will say things with great certainty, and just constantly be thinking, how do I make the best decision for today's circumstances? And it's never too late to turn things around. It's I've seen it done. Just be careful and be wise.
Be careful and be wise. On that, let's wrap this up. Thank you very much, guys. Let's go buy a property. See you later.
Sounds good. See you guys. Good night.
Bye.